So these are all examples of expense. So you already know what an expense is. If it's an expense, what do? I said all expenses take debit. So in your ledger account, you are going to debit the expense. As long as the expense is increasing, if you have 20 of them, you know that they are increasing. Once the expense is increasing, it means they are all coming to the debit side. If they are reducing on the other side, it means they are going to the credit side. I will explain more. The next thing I want you to also remember is assets. All assets take debit. That is their natural sitting position in the ledger account. When you do a T account, all assets will sit comfortably, normally, naturally in the debit side, never on the credit side, except if there is a reduction. That is the only time that they will go to the credit side. If not, their natural sitting position is always on the debit side. You may want to ask, how do you recognize an asset when a financial transaction or event occurs? How do you know that this is an asset? An asset is a resource, a present resource that is controlled by the entity as a result of a past event, okay, and which will bring about an inflow of resources embodying economic benefits to the entity. Do you understand? I'll say it again. As I told you before, I don't want you to memorize. I want you to understand. So, that is what an asset is. It is a resource, a current resource, a present resource that is controlled, not owned, not necessarily owned. It could be owned, but it is not good for us to use that word, owned. What if it is not owned? Like a finance lease, it might not be owned by the person who is using it, but the person has control. And what is even control? Control is the ability to direct that asset to work for you. To direct the asset to work for you and bring about economic benefits to that entity. So if you are able to direct that asset to work for you, to bring about economic benefits, then you have control. Okay? So that is what an asset is. It is a present resource that is controlled by an entity as a result of a past event, and it will bring about an inflow of resources embodying economic benefits to that entity. Then we'll say it is an asset. And this asset could be of different types. It could be a current asset. It could also be a non-current asset. Now, when you talk about current and non-current, we're talking about the asset that can be easily converted to cash under 1 year, one accounting year. Then we're talking about current. It is current. But if it is going to take more than 1 year, then we say it is non-current. It is no longer current. So the definition of current has to do with one accounting year, usually. Also, an asset could be tangible. It could be intangible. But that is not what I want to talk about now. But just remember, an asset could be one that is can be physically touched and held. That is a tangible asset. And it could be one that you don't see at all. It could be something like patent, copyright, and all that. It's intangible. You can't see it, but you know it is an asset. So, if it is an asset, what do? You debit the asset. Naturally, as long as the asset is increasing, you have the natural sitting position to be on the debit side. The next one that you also debit is what we call drawings. What do we mean by drawings? What is a drawing? A drawing is the money you remove from the business. You have your capital, and then you decide to remove money for your personal use. It is not related to the business. It will not bring about an increase in your revenue, it will not do any good thing for the business. It is not for the business. It is for your personal use. For example, you take part of your capital and decide to go marry a second wife. That is a drawing. It has nothing to do with the business. So it is a leakage, as economists will say, in the principle of injections and leakages. It is a leakage from the business. You draw it out of the capital, out of the entity, and it is not for the use of that entity. That is a drawing. In other words, it reduces your equity. It reduces your capital. So when that happens, what do? We debit it. So I'm telling you that if you remember DEAD, dead, you can now recall, always remember that for every, let the first D be for debit, then you know that the E that follows is for expenses. All expenses take debit. The A is for asset. All assets, irrespective of their type, they all take debit. And then the D is for drawings. All drawings also take debit. This is how to demystify the principle of knowing what to debit and knowing what to credit. It is what I call the T account trick. Now let's go to the credit side. That is the right-hand side, the credit side. The credit side, let that C stand for credit. Then after the CLIC, that is CLIC, click. The L will now be for liability. Your liability is to be credited. Liability is to be credited. What is the liability? It is the mirror opposite of your asset. The liability is the mirror opposite of the asset. It is a present obligation. Remember that we say that asset is a resource that is presently controlled. Now we are saying that liability is a present obligation. It is a present obligation. As a result of a past event, the settlement of which will bring about an outflow of resources embodying economic benefits or economic resources. Do you understand? So it is a present obligation as a result of a past event. And to settle this present obligation, there must be a leakage. There must be an outflow of resources embodying economic benefits from the entity. There must be an outflow. You must spend money out to settle that present obligation. That is what we call a liability. So for every liability, their natural sitting position in the T account is on the credit side, not on the debit side. The only time that you can now debit is when you are reducing your liability. I told you that for assets, their natural sitting position is on the debit side. The only time you credit is when you are not increasing, but you are reducing the asset. Good. Now, after the L, don't forget the mnemonic CLIC. Let's go to I. What is the I for? I is for income. Income is like the opposite of an expense. All right? It is not a depletion. Rather, it is an enhancement. Okay? It is an enhancement. So when you have an increase in the economic resources of an entity, as a result of what? As a result of inflows or as a result of enhancement, then we say it is an income. It is an income. How do you get an inflow? An inflow, for example, you calculate, you make some sales and remove your expenses. What do you have? You have an income. That is an income. Okay? That is technically the difference between a revenue and an income. So the revenue is like the raw data of what you sold. But when you make some deductions, expenses less, you have an income. But that's not where I want to go. I want you to focus on how to treat an income. So an income is an inflow of economic resources to the entity. As a result of what? That is an enhancement in the economic resources of the entity. In other words, the equity of the entity is increasing. What is making it to increase? It is increasing because we have inflows into the entity, or because we have enhancement. What do we mean by enhancement? We're talking about something like revaluation. You have the value of this seat. Perhaps it is 70,000 naira. You are carrying it in your books. The what do we call it? The costs, historical cost of the asset, less the depreciation to date. You are carrying it in your books. That's the carrying amount or carrying value. You are carrying it at 70,000. And then all of a sudden you discover that inflation, there's inflation, fuel price has gone up, so many things have happened, and so all over the country, prices of goods and services have gone up. And then you bring an actuarian to revalue that asset for you. And the person tells you that, no, this asset is no longer worth 70,000 naira, it is now worth 100,000 naira. That is an enhancement. That is a revaluation. So that also is an income. Now, when this happens, how do you treat it? If you have a transaction, a financial transaction, a financial event, how do you treat it if you can identify that it is an income? All income in the ledger account take credit. That is their natural sitting position. You must know that. The last one I want to talk about in the CLIC, C-L-I-C, is capital, or what we call equity. Equity is technically the best language to call it, but let's just call it capital so we stick with our C. Your capital is the money that you introduce into the business. Everybody knows what capital is. But why I said equity is the best to remember it, equity describes it better because equity is what belongs to the shareholders, the owners of the company. And when you don't pay dividends, for instance, you decide to retain your profit. That profit is added to the capital, so the capital also increases. All of this, all the reserves, everything belongs to the ordinary shareholders, and we call them equity. Why do we call them equity? They are the people who have the good, the progress. They are the people who want the best for the organization. They are those who have sacrificed their funds by putting in their capital. So, upon liquidation, all classes of creditors will be paid. And then if there is a surplus, it goes to the ordinary shareholders. But where you realize, by realizing, I'm talking about selling, when you realize the assets, all the assets of the organization, and settle all the creditors, and maybe it is not enough to go around to settle your creditors, you see that the capital contributed by the ordinary shareholders is lost. And so we call them equity. So equity is made up of the capital they contributed, all the reserves, whether they are revaluation surplus, whether they are all types of reserves, and retained earnings, whatever, it all belongs to equity. We call them collectively equity. So just remember that the C in the debt click stands for what? It stands for capital, and capital takes credit. Now, at this point, I want us to look at the board.